Hey, I'm back. Last week I gave an overall overview of what we mean by deep tech with some examples. I also talked about the investment opportunity and how the returns and exit timelines are actually quite good for deep tech. But this was all a setup for today's video when I will get into what's really different about investing in deep tech startups. Today I'm going to break it down into three parts. First, I'm going to get into the type of risk at each stage of a deep tech startup's journey and compare that to other types of startups, such as in SaaS. Then I'm going to map that to the types of capital that are available to deep tech startups along the way. And I'll finally give an overview of what we typically look for in early stage deep tech startups compared to what we would look for in a non-deep tech startup. As a reminder, here are some examples of what we mean by deep tech. What they have in common is that innovation is backed by strong research and engineering, and we're expecting breakthrough innovation that could create entirely new markets. One thing I'll say here that it doesn't make sense to be a deep tech generalist investor. It should be obvious that the nature of these technologies requires some expertise and access to ecosystems that require you to be somewhat of a specialist on technologies or a specialist in the application of those technologies in certain industries. But when you look at the life cycle of a startup, it's different for deep tech than for traditional VC. So if we take, for example, a typical SaaS startup. Now, apologies for oversimplifying a little bit because I've got a lot of opinions on SaaS and I've studied this quite a bit. The risk of oversimplification, we look at three kind of main stages of risk for VCs investing in startups, and in the example of like traditional VC in SaaS, for example. And Steve Blank uses, rather than this idea to MVP, PMF, and scale up, uses the term search, build, and grow stages. But if you look at like what are the risks that we're taking on for each of these, like from the first kind of idea to getting an MVP out the door, you would think it would be product risk, right? Can you build something? Um, and then market risk. Is there a buyer for what you're building? And then execution risk is can you actually grow it? But actually, when you think about it, really for SaaS especially, each one of these is execution risk because it's very easy to test new ideas and new business models in areas like SaaS. So it's really about execution at each of these stages. A little bit the skill set you need, maybe a little bit different, but it's all about betting on a team that can execute to take something very, very quickly from idea to getting a product in the hands of actual customers to test to see if you have product market fit, and then iterating on that and expanding from a wedge market to grow to additional markets. But with deep tech, it's not quite that simple. First of all, you're starting in a lab. You may be years from commercialization, so there's some initial risk that you're taking on in just R&D risk. Is it even possible to do this? You have an idea. You may have filed a patent for that idea, but you need some time in the lab to figure out if it's even possible. Prototype is to demonstrate that you can something in a working environment. Can it work? It may not. You haven't proven any of the economics of it. You haven't proven that it's stable, for example. But you've proven like in a limited way that it can work. And then from pilot to what FOAC means, first of a kind, you started getting into engineering risk. Can you industrialize it? Can you build a pilot plant? Can that pilot plant turn into an actual commercial plant, first of a kind? Maybe the first time anyone's ever built something like that. And then scaling is then you're taking something and either repeating or growing it, and then you really get into execution risk. And the form of risk is actually quite different. And there's a valley of death, whereas there was a valley of death typically in SaaS startups somewhere between seed and Series A, where you go from kind of you've got evidence of product market fit, but you haven't got that flywheel to really see nonlinear growth. In deep tech, the valley of death is there's one in like somewhere between R&D and prototype, because you often run out of funding before anyone is willing to take the risk on your deep tech startup. And then there's another valley of death where things can get very capital intensive. And all of the examples I talked about, whether it's AI or materials, typically lots of capital involved getting to the scaling phase. So let's talk about the different types of capital that are available for deep tech startups. First of all, when we're at the research stage, preferably you're getting access to government grants or having partnerships with universities to share some of the costs of research and development. And then we get into, as you get into having a working prototype, that's where it gets more interesting for deep tech VCs. Now, deep tech VCs specialize in deep tech, but don't necessarily have more appetite for risk. They just understand deep tech more. So good ones have a strong team or a network that helps make good picks, ask the right questions, helps get resources to scale, whether that's financial or people or partners, corporate partners, for example, that the deep tech VCs may have access to. And that will typically take a startup into a pilot and into FOAC, first of a kind stage. But scaling, where things get a lot more capital intensive, are not the specialty of deep tech VCs. And this is where, depending on the type of startup, if it's very asset heavy, then access to debt financing, whether it's venture debt or structured financing, partnerships with corporations to offload a lot of that capital intensity to corporations. Project finance. There may be, actually in the U.S., there's a lot of government programs to provide financing from the Department of Energy, for example, and their equivalents in Europe too. Let's talk about what we look for in a startup. I'm going to start with just traditional VC, where we invested in the past, SaaS marketplaces. I'm going to reframe that as business model innovation. It's really about execution on the business model that's important, more important than the technology, compared to deep tech, where the technology really is a big major part of the value of the company. So business model innovation, I mentioned in this area, like kind of traditional VC, we always talk about the team is so important because I mentioned that each of those stages of risk, really it's still about execution risk. Can the team execute? Can the team take something from an idea to an MVP and get it in the hands of the customers and grow it? So team is really important. Traction is really just evidence that the team is doing their jobs. And traction is measured in different ways along the different stages of a startup's life cycle. So depending on when you come in, you're looking at different things. At early stage, you would look at things like, are they acquiring customers? Are they retaining those customers? And are we seeing some evidence of nonlinear growth that's possible? You should be able to get those signals quite early in a startup's life cycle for like digital types of technologies. And then the tech is less important, mainly because the tech is usually not that novel and usually fairly easy to reproduce and hard to protect. So the tech should be current. It should be somewhat unique, but it is not the number one thing we look at, and we'll look at a team interaction before that. And then finally, the market size. I will argue that the market, however you want to measure the market at different levels of granularity, the TAM, the SAM, the SOM, doesn't matter to me. A good team will find its TAM. A good team that can execute, that finds a wedge market to get into, and those customers love them in that market, can grow to additional markets. Because with business model innovation, it's not that hard to grow your product portfolio, do pivots and things like that to capture large chunks of the market. Just typically. Deep tech, the tech is obviously the most important thing. It's an asset, and it's the number one thing you look at. Is it novel? And then second, does it have utility? And that's where TAM comes in. We want to know that the technology is unique and there is a market. It's hard to get really good signals up front for deep tech startups, a total addressable market, but we want some confidence that there is a market for whatever is being built here. And may sound strange that TAM is more important for deep tech startups when we may not have the data, but you need some confidence, because I'm going to throw another catchphrase out there. It's hard to pivot a patent. And then team is important, I would say, because they need to be able to do what they need to do at each stage of that startup's life cycle. So at the beginning, obviously the R&D team, looking at the credentials of that R&D team, that they know what they're doing. But the team in deep tech, we can usually help augment the team with the gaps that they may have. Typically, a startup that starts with scientists and engineers will need salespeople, will need financial people along the way, but they may not need them at least full time at the beginning. So the team is a little loose in terms of whether it's as important as with is business model innovation. That team needs to deliver, needs to be pretty strong from day one. So there you have it, some thoughts about the deep tech investing, how we look at risk and what we look for in a startup. Look forward to seeing your comments in the chat. If anyone has some any other ideas or comments, please share them in the chat or connect with me on LinkedIn.